welcome to another edition of the Goldman Guide. This weather is something else, huh? Between the volatility in weather changes and volatility in the market last week, what do we do now? Well, today we've decided to define exactly what is going on, the future potentialities, and with the aid of some awesome data from Schwab Financial Research, by the way. Plus, we highlight a stock you need to put on your watch list, as it could enjoy a big bump in the coming months after a likely drift lower. So without further ado, here we go in just a few short minutes. We've been officially negative about the market for a couple of weeks now, and the combination of the awful retail financials as we expected last week and the real life inflation concerns, stocks took their biggest dive of the year. Now, let's review exactly where we are, because all the major indices dropped about 3% actually for the week. Still, it leads to only one index being down year to date, and that's the Dow Jones Industrial Average. Interestingly, the NASDAQ composite is now down over 22% from its 52-week high. That's pretty wild, huh? It's a pretty sharp decline. Just like last week, major inflows of short-term debt in the ETF world occurred. Now, what were the inflows exactly? Short-term debt like treasuries and short-term bonds. They all tend to be government high quality. Those inflows were about $5 billion, but the outflows almost doubled that amount. And we mused about the one-year Treasury paying over 5%, and it looks like there are definite shifts there, and away from big ETFs like variations of the S&P 500 index, which were major culprits on the outflow side, along with the others that might carry a great deal of risk. Still, investors don't know what to do or make of the current situation, and that's evidenced by the neutral percentage of the AAII Investor Sentiment Survey figures of last week. Forgetting the bullish figure, which cratered from 34 to 22, understandably so, but the neutral figure of 40% is actually pretty noteworthy. And that's because it's the highest level since March 31st of last year, which coincided with just a couple of days after the market hit its peak. Clearly, investors just really don't know what to make of things, especially with this uncertainty regarding inflation. So, with this uncertainty and the negativity, does it mean that we've corrected? We've been in a bear market, officially, quite frankly, since September of 2023. But let's take a closer look at the indices and the former FAANG group to see if we've entered a new version of a bear market or a new correction. Now, just for you nervous Nellies that think this is the beginning of a bear market or another correction, think again, and you'll see that from some of this data. So, the definition of a correction is an index or stock that's declined 10% or more from a recent high. We're not in a market corrective phase yet, but as I said, we did hit that low in September of 2023. So, theoretically, and quite literally, I believe we are in the bear market. And the increase that we saw this year was merely not a bull market, but a positive corrective phase inside of a bear market. And you can see that we had these big drops year to date from early February to last week. And although we're not in a corrective phase specifically or literally to that 10% level, we have endured some of these pretty big drops. Now, on the stock side, looks like we're in a corrective phase in a couple of stocks. Google, Netflix. We're talking about the former FAANG guys here, right? Facebook, Apple, Amazon, Netflix, Google. Of course, now they're Meta, Amazon, Apple, Netflix, and Alphabet. But Netflix and Google down double digits. Amazon almost beating that as well. So, given the fact that NASDAQ Composite is comprised of these guys, and they're such huge components and hugely followed. Institutions own them, retail investors own them. Where they go, so does NASDAQ and many stocks in the market as well. So it is important for direction to keep in mind and keep an eye on these things as well. Now, bear markets, as I said, typically reflect a decline of 20% or more for indices, which occurred in September off of the high in March of 2022. Now, in addition to the bear market, which I believe we're currently in, if you go back to 1974, there have been a total of only 6 bear markets that have evolved from corrections. that should make you feel pretty good because it shows that a correction doesn't necessarily lead to a bear market. And also, most of these bear markets, as you'll see, duration wise in terms of time, but also the actual total decline as well, are not as bad as we all make them out to be because we don't want a single day to be down, let alone hundreds of days. The average duration of a bear market, 446 days, about a year and a quarter, but the average duration of a bull market is 2069, almost 6 years. And the return, over 200% in the bull market and down 38% for the bear. So, what's our take given this information? Inflation problems could lead to a market correction, which continues this bear phase, but it won't lead to a new bear market. However, in the fourth quarter of 2023, it could start the beginning of a bull run. The S&P 500 went into the bear territory, and so we're in about 156 days or a third of the average. Now, it did peak since then at the 14% range earlier this year, as we mentioned. But if we do break out of the bear territory, I believe we're in late 2023, that duration nearly matches the average bear market duration noted above. So we're going to stick to our original January outlook, and that is it's going to be a rough year, but a strong ending. So you should feel pretty good about that, and hopefully we're correct. Now, enough of the market. Let's talk about a stock well liked by a lot of investors. The company well liked as well. You know, sometimes investors can make a lot of money by just watching the right stock and making a plan regarding its fundamental and technical future performances. So, with that in mind, how about putting Chewy, ticker symbol CHWY, on your screen? We love them. Been a customer for a long time. Stock's pretty bad right now, as most are. But as you can see from the chart, in late 2022, hit a double bottom and then soared before dropping. And then after bouncing off of that similar level, it hit a 52-week high just a short while later before its recent declines. And this is just in the past few months. Now with Chewy, we think three things. One, it's poised to drift back to that level that it was trading at previously in the low to mid 30s. Two, fundamentally, it will do well in the upcoming months or quarters or seasons. You know, the decline is pretty obvious to us because there really is nothing underlying that appears to drive the stock higher. But the fundamentals will soon catch up in the coming quarters or seasons since we are going to be entering a period where they do pretty well historically. Three, we believe it can bounce off this mid 30s level and enjoy a run again, as it has proven in the past, because its history a lot of times has been run, sell off, run, sell off. It's just how it is. And valuation wise, we believe it would be very cheap and attractive on a price to sales basis if it does in fact drift. So watch it and consider playing it around 33, 34. Also consider using them if you have pets. It's a great service and a money saver too. So if you have any feelings or ideas about anything we talked about today, please drop me an email. I welcome your thoughts. Now remember, nothing we discussed today is a recommendation to buy or sell. Everything we discussed is for informational purposes only. That'll do it for this week. Thanks for listening, and we hope you have a great week.